It is exactly 3:01. And I have just entered the meeting about 40 seconds late. Okay, about it's 3:06. I have no customers, it looks like. So I will get going with a lecture for my wonderful 3 time a week Accounting 230 class. And we're going to go into chapters 4 and 5. Chapter 4 is a very important chapter, very important. Chapter 5 is a little, I would say, less so, because it talks more about the institutions of accounting as opposed to preparing transactions and analyzing. So let me get comfortable and turn this thing off. Okay. All right. I have no visitors for class today. I hope that means that you've been looking at the videos we posted, worked hard in the class assignments, the homework, maybe went to some tutoring, and are going to succeed on that basis, huh? So chapter 4 begins with adjusting journal entries. Adjusting journal entries. Everything we've done in the course thus far has been in the realm of what we call external journal entries, external transactions. We bought things from people, we sold things to people. We paid our employees, we collected cash, we sold other things, paid bills. Those are the normal external events that happen throughout the normal month. Now the month comes to an end and we will print out a trial balance. And you learned a little bit about a trial balance, but that trial balance by definition is incomplete and inaccurate. There are certain entries that still need to be made at month end. There's no getting any way around it. And this is true of any business in the world. Adjusting journal entries, okay? Management is responsible for the financial statements, which must be of high quality and relevant, hopefully, reliable, audited, blessed, and useful to external people, investors, creditors, possible investors. And we talk a bit about the accounting cycle here. So what we've done in chapter 2 and 3 is really this first purple area here. The month began, we analyzed transactions just about every day. Everything from the electric bill comes in the mail, you look at it and say, whoop, that's electric expense, utilities expense. We're going to write a journal entry for that. And you're writing journal entries throughout the month in our course to record financial transactions as they occur. And you hit the button that says post, and you have posted them to the general ledger, okay? Now the month ends, and we're going to print out a trial balance. And as you should know, trial balance is simply a listing of every item in your chart of accounts listed debit and credit side by side, just a 2-column thing, debit, credit. And the only thing it does is prove that debits equal credits. At that point, it's time to do our adjusting journal entries. Once we've prepared the adjusting journal entries, we will create a new trial balance that I like to call the final trial balance, huh? The adjusted trial balance. And it is from that adjusted trial balance that we are going to prepare the financial statements, send them out to the world, and then we're going to do our closing entries. So let's get going here. The purpose of adjustments. It's all about the matching principle. The matching principle simply means you're matching revenues with expenses. A good example of an adjusting journal entry would be payroll. You worked for my company, and I pay you every 2 weeks. You worked the last week of October. But you're not going to get paid for that probably until November 14th, maybe today, something like that. But you did work those hours during October, even though you're going to be paid in November. So we have to accrue that expense in the month of October. That's when you worked. That's when you earned that $1,000. So we're going to have an adjusting journal entry where we debit salaries and wages expense, perhaps, and credit an account called accrued salaries payable. The word accrued should be in front of it. It's a current liability. At the end of that month, even though you're not going to get paid for maybe another 2 weeks, the company still owes you that money at that point in time. If you quit that day, we have to pay you right there. If unfortunately we have to let you go or fire you, we have to pay you that day. If the business burns down, they owe you that money. When you joined the company, you simply agreed to wait 2 weeks for your paycheck. Used to call it holding back 2 weeks, okay? So we wait until the end of the month, the accounting period, to adjust the accounts. We could do it every day, but that would be kind of time wasting. Be reinventing the wheel every day. So let me take you through this grid here. Try to make this as simple as possible. And what do we have here? We have types of adjustments, huh? And we have something called deferred revenues and deferred expenses. Deferred revenues, deferred expenses. And let's talk about the deferred expenses first, because this will be a fairly big part of your adjustments. We bought assets like prepaid rent, prepaid supplies. We bought equipment, long-term asset, huh? We bought a $100,000 machine. These assets were created when cash was paid in advance, and they must be reduced for the amount of expense actually incurred during the month. So briefly, I'll take you through one such transaction. Prepaid insurance. On December 31st, 2019, you bought an insurance policy for $12,000. But that policy goes into effect the next year, meaning the next day. So if you were unlucky enough to have your business burned down on New Year's Eve, you're out of luck. You have no insurance. Next day, you would be covered. Now, that insurance policy is an asset. It is a prepaid asset that we're going to consume during the year. I said $12,000. That means we have to recognize an expense of $1,000 every year. So you're going to debit insurance expense and reduce that asset by 1,000, prepaid insurance. Deferred revenue is the same thing as a deferred expense, except it's on the other side, the person who is selling the insurance policy. When we bought that policy, we had no insurance on that date, so it's a prepaid asset. To the insurance company who sold it to us, he calls it unearned revenue. We paid him $12,000 in cash. When we bought the policy, we debited prepaid insurance and we credited cash. Well, this guy certainly didn't credit cash. He got our money. He debited cash, but he will credit an account called unearned revenues. An unearned revenue account is a liability account, with a credit balance. This company that sold us the policy, State Farm or Allstate or whoever, they have not provided any insurance to us yet. So they can't call it income. They have to do what we're doing, which is recognize, in their case, $1,000 worth of revenue on the income statement every month and relieving this liability by 1,000 every month. Another point I'd like to make with deferred revenues, what's deferred is the service. The service is deferred to a future period. Another thing with deferred revenues and deferred expenses, money changed hands, but nobody's done anything. Money has changed hands, but the purchaser of the insurance cannot record an expense yet nor can the insurance company claim any revenue at that point. Okay, so that's an example of some of the entries we're talking about. The first one, I talked before about an accrued expense. I started to go into deferreds and I ended up talking about an accrued expense. That was the salaries. And another deferred expense would be your depreciation. And that's the easy one because it's always a debit to depreciation expense and a credit to accumulated depreciation, that contra asset account. You're not going to credit the original cost of the asset. You just don't do it. You don't do that. What you have to reduce, though, is the net book value, meaning the original cost minus the accumulated depreciation. And lastly, you could have accrued receivables, accrued revenues. What we're talking about here, guys, is interest income. We were in a position where we loaned somebody $100,000 at 12%. So every year at the end of the year, this guy has to pay us $12,000 in interest income. But we are earning it month by month by month. So every month we're going to write an adjusting journal entry recognizing that in January we accrue $1,000 of revenues. We'll call it interest income, credit interest income, $1,000 each month, debit interest receivable. So let me just keep going here. 3 steps in the adjustment process. Was it a revenue or an expense? I'm going to give you a tip. Nearly all of your adjusting journal entries are a search for unrecorded expenses, okay? The exceptions would be the unearned revenue, and if you loaned out money, you might have some interest receivables to accrue. And then you're going to figure out, was the related cash received in advance or whatever, and come up with your number. So we're going to go through a bunch of scenarios now, demonstrating when you have to make an adjustment and when it's not necessary. Here, we sold our product or provided our service, and the customer paid us immediately. We delivered pizzas to a big banquet here on campus, and we paid the guy when he delivered the pizza. So he gives us the bill, and we tell him, stand there, pal, we'll give you cash. And he gets the cash, and he debits cash and credits revenue. There's nothing to adjust there. That transaction is done. What if, though, we had to pay this guy in advance? If cash is received before the company delivers their stuff, the liability account, unearned revenue, is credited. And when the goods are delivered, then we can relieve that liability by the amount of the pizzas. So here we paid, say, $1,000 in advance. This guy received our $1,000 and he credited unearned revenue. It's a liability account. He does not owe us money. He owes us pizza. Or a better example that I like to use as a big sports fan, I send the Dodgers a check in February for season tickets for the upcoming season. They get my money and they make this entry. They debit cash and they credit probably something they might call unearned ticket revenue. So they owe me $12,000, not money. They owe me $12,000 worth of baseball. The season is 6 months long. So every month as they play baseball, they will debit this liability account and credit the regular revenue. So that's a classic adjusting entry. And I can't see what's down here. Let me see if I can move this out of my way here. Yeah, there you go. There's the entry when they perform the service. The Dodgers played some baseball in April. So that's $2,000 that they paid back in terms of what they owed me. So get money in advance. Yes, you need an adjusting journal entry. This is just a normal business transaction you did in the first couple chapters here. Simple. We paid this guy after he gave us a bill. So we're in that guy's shoes now. He delivered the pizzas. He handed us a bill, and the deal is we pay in 30 days. So we're going to debit. He is going to debit rather accounts receivable and credit revenue. That's the end of it. There's no adjusting entry to be made. I don't care what that says. There is no adjusting entry to be made. This is not an adjusting entry. This is normal debit to cash, credit to receivables. Okay. The matching principle. Now we're talking about paying cash, huh? When cash is paid on the day the expense is incurred. Okay. We had somebody come into school and he repaired our copy machine. And he finished it and he handed me a bill for $100 and I paid him. The school paid him. That's a finished transaction. There's no adjustment needed there, huh? No adjustment. No adjustment. Here is a different story. Here is a classic adjusting entry. If cash is paid before the company receives the goods or services, we must put it into an asset account, a current asset account called prepaid expense, such as prepaid insurance expense, prepaid supplies expense, prepaid rent, prepaid taxes. It could be a lot of different things. So the deal is we paid in advance. We paid in advance. This is us sending money to the Dodgers. When we sent that money to the Dodgers, we credited cash and we might have debited maybe prepaid season tickets or something, okay? An asset. If it was insurance, we would debited prepaid insurance expense. So that $12,000 is now sitting at the end of the year in this asset account. The new year begins, and yes, we have to adjust this. We have to adjust it. And we do so with this journal entry here. I said we do it with this entry here. Look what we did. We put the whole 12,000 into the prepaid account, but every month throughout this following year, as the insurance coverage is in play, we're going to debit insurance expense and credit prepaid insurance, okay? Let's see what else they have. Well, this is pretty typical. This is from the first chapter or two. We pay after. This is how the whole world does business mostly, huh? Somebody came in and did some work for us, or they sold us something. We debit the expense. Somebody came in and did some repair work, debit the expense, and they hand us a bill. We're going to pay it later. That's just a transaction going into accounts payable. Does not require an adjustment. Does not require an adjustment. That is not an adjusting entry, okay? But it's the basic thing we learned in chapters 1 and 2. Let's talk about the types of adjustments again, and we'll go over this in a little more detail. Mostly you're going to be looking for expenses. But let's start with the revenues. Unearned revenues. One man's unearned revenue is another woman's prepaid expense. Okay? Prepaid expense. You purchased an insurance policy. You purchased it. And when you purchased it, the policy's no good right now. But when it goes into effect, you're going to start crediting these prepaid assets. And here, the person who received our money, the insurance company, they're going to debit, thus reducing the credit that sits in the unearned liability account, and they are going to credit insurance income or revenue, whatever they say, okay? Deferred's money paid in advance. Nobody did anything. Deferred's money changed hands, service was deferred. Accruals are sort of the opposite. Accruals, nobody went to their wallet. An accrual entry, by definition, does not have cash in it. It means that an activity occurred, an expense was incurred, and having incurred that expense or experienced it, we must record it. And a simple explanation of an adjusting journal entry as an accrual was the wages I did before, but here's an easier one. The month ends and you're looking at that trial balance and you notice it has 0 utilities expense, 0 electricity expense. Well, you know you used electricity during the month, but you're not going to get the electric bill for maybe 25 more days. Do you think Bill Gates and Microsoft tells the world, well, you have to wait almost a month to get my financial statements because we don't have the electric bill in from San Mateo? No, of course not. We have to estimate a number there. It can't just be any number. It has to be what the accounting lexicon calls systematic and rational. Out here in Southern California on the Central Coast, we don't have a severe weather change throughout the year. So our electric bill has been running the last 3 months, 1,900, 980. Let's accrue it. Let's accrue 1,100 this time. So we would debit the expense, electricity expense, and credit accrued electricity payable or accrued payables, okay? Accrued expense. Same thing with here, the accrued revenues. Here, what we're talking about is really interest. We loaned money to somebody, and every month we must debit interest receivable and credit interest income. So this little grid here is quite helpful. And so is this. Now, we already went over this. I would suggest when you're doing your exercises, have this window available somewhere, side by side with the homework on your cell phone or print it out or something, because this is quite helpful. You get the sense there's 4 types of adjustments: accrued revenues and deferred revenues, and accrued expenses and deferred expenses. Accrued, no money, money paid later on the accrueds. Okay, wow, look at this. We did we're going to do our adjusting entries now, okay? So the first thing we do, it's now the first day of the new month. You walk into your office and you print out a trial balance, which is just a listing of everything in your chart of accounts with a balance, I guess. And it shows the debit and credits listed side by side in sequential columns. And if the debits equal credits, we have a big party. We're good so far. So here is an unadjusted trial balance. Oh my goodness, this is an ugly looking thing. Holy cow. Where did this come from? Hold on. Let's find something better than that. Here is a trial balance, blank, unadjusted. This is what you printed out as soon as the new month or year began. And if you look at this thing, you're going to notice something. I don't see any interest receivable there. I don't see any supplies expense, do you? I don't see any depreciation expense. I don't see any insurance expense. It's very possible we need to record that now with an adjusting journal entry. So let's see what we want to do here. 4 types of adjustments. Oh, no, we're not going to go through this again. Okay, so let's take a look here. Accrued revenue. Matrix apparently loaned money to somebody. Maybe they loaned $1,800 or whatever. They loaned $1,500 at 12%, whatever it comes to. So they have to recognize 1 month's interest, okay? The interest per year is $1,800, 12 times 1,500. So every month they have to record this adjusting journal entry to accrue the revenue. Notice with the accrued revenues, the accrued entries, no cash changes hand. So take a look at that. Let me get this out of my way if I can. Get up there. Okay, maybe that'll help me. So take a peek. In our entry, debit interest receivable, an asset, credit the revenue account 150. So look at the interest receivable. We had 0. Now we have 150. Look at your interest. Same thing. They had not recorded any interest revenue. That is the adjusting journal entry, the accrual of a revenue and accrued revenue. Now, let's talk about an unearned revenue. An accrued revenue is where no money changed hands yet, but somebody owes you that interest. Here, we're in a deferred revenue, in unearned revenue. We know that the rent received in advance is an unearned revenue. So Matrix had gotten a check. They got a check for $3,000 for the first 4 months' rent. They got the check on December 1. So when they got that money, they debited cash for $3,000, had received a check for $3,000 for the first 4 months. Okay, so they debited cash for $3,000, and they credited unearned revenue. Now they have to recognize 1/4 of that because December 1st has elapsed. So in December 31st, they make the following journal entry. They took that check for $3,000, divided it by 4, and at the end of December, they can now claim rent revenue and reduce the $3,000 liability in unearned revenues. Okay, I will take us here. Rent revenue. Now we've recorded that. December 1st, they increased this liability account for the receipt of that $3,000 in prepaid rent. And now, after the first month, they're debiting this, crediting rent revenue. And guess what they're going to do next month? They're going to debit this again, $750, again and again, until this, at the end of 4 months, this unearned revenue will go down to 0, meaning they have paid off the liability by allowing you to stay in your apartment for those 4 months. And the rent revenue will show $750 each month. So you can see how we're matching up in the proper month. Wow, man, oh man, they're really overdoing this, huh? Okay, I don't think we went over an accrued expense. An accrued expense, you can accrue almost any expense if necessary, rent, interest, wages, all kinds of things. Accrual. As of 12/27/14, Matrix had already paid $19,000 in wages for the year. So as of that date, they had already recorded and paid this $19,000. Okay, but they pay their employees every Friday. They pay their employees on Friday. Let me read it. Pays its employees every Friday year end. So December 31st falls on a Wednesday. That just means that these people worked 3 days. They worked 3 days during this period, and they earned $500. They worked on the 28th, the 29th, the 30th, and the 31st, 4 days actually. And you earned $500. Even though you're not going to get paid till the following Wednesday, it looks like. Matrix must put this into wages expense and a credit to accrued wages payable. Let's take a look. These 4 days of expense belong in December, and that's what we're doing, December. You debit wage expense and you credit accrued wages payable. Your book says wages payable, that's okay, but you really should put the word accrued in front of it, okay? So I think you're all familiar with that. You're all working men and women, I know that. And we're looking at the T account. Wages payable, 0 to begin with. And then we credited it for 500, so that's the balance. Remember, they had already processed 19,000 worth of payroll. that paid everybody through the 27th. You worked for 500, you made $500 in those 4 days. So the total payroll expense is 19.5. 19.5. Prepaid expenses. And I think these are kind of easy ones. Prepaid expenses. The Matrix paid $3,600 for a 3-year insurance policy. Wow, they're paying it 3 years in advance, huh? That's 36 months. Would you agree? Or $100 a month. So they must recognize that portion of the expense. So it's $100 per month, or 3-year. When did they buy this thing? They bought it on. Where are they coming up with? Oh yeah. It's 100. Yeah, this is for a whole year. They're doing this for a whole year. I was thinking it was just December. Okay, so at the end of the year, Matrix decides they're going to run financial statements, and they recognize that they've consumed 1/3 of that $3,600 prepaid asset. So that asset must be reduced with a credit and insurance expense debited. Classic prepaid expense. You would do the same thing if it was prepaid insurance. I bet they even give us, well, this was insurance. It could be a lot of different prepaid items. Here's what your T accounts are going to look like. At the beginning of the year, you're going to have the $3,600 you paid in advance. At the end of the first year, we're going to take 1/3, knock the balance down to here. The second year, we're going to do the same thing. And then the third year, when the balance is 12, we zero this out. And every year, you're going to show $1,200 worth of expense, $1,200. Prepaid expenses. This is another deferred expense. Not really, I don't think you want to call it prepaid expense, but it's a deferred expense. This is depreciation. Matrix bought a truck for $6,600, which they plan to use for 3 years. They can now depreciate that truck, depreciate it. And there are various methods to do that. We're going to start with straight line, which is easy and the most common one, I think. So let's take a look at this. Let's see. We paid $6,600 for this truck, and after 3 years, we're going to get rid of it. No good. They must recognize the portion of the truck cost that has been used to generate revenues. Well, under straight line, 1/3 would be $2,200. You see how we got the number? $6,600 is what we paid for the truck. We divide it by 3, and the depreciation expense becomes $2,200 a year. And notice that we do not credit the truck. You never credit the original cost of a fixed asset. Not for a few more chapters when you sell it. But as long as you have this truck on your general ledger, you can never credit it. What you have to reduce, though, is the net book value. So this truck, when it was purchased, the net book value was $6,600. There was no accumulated depreciation. At the end of year 1, now we have depreciated at $2,200. Understand again that accumulated depreciation is a contra account. All of your contra accounts are married to something. Accumulated depreciation is married to the fixed asset. So after the first year, the net book value would be $4,400. Here's a look at the T accounts. Depreciation expense, $2,200. And they bought this truck right at the beginning of the year. Okay. So now we're looking at this blank template for our adjusted trial balance. Now take a look. Remember, we didn't have wages expenses earlier. We did not have depreciation expense. We did not have insurance expense. We did not have interest revenue. We did not have any accumulated depreciation. I don't think we had any rent revenue. I don't recall. So let's see what our adjusted trial balance looks like. the adjusted trial balance, okay? This is the final. Blessed. This one has been blessed by the big shots. This is now the final trial balance. And notice we filled in all those gaps or added whatever we needed to add. Now that we have the final adjusted trial balance, we've done the hard part. The whole hard part in the closing process is preparing the adjusting journal entries correctly. Once you do that and come up with the new trial balance, you just use this trial balance to prepare your financial statements. And remember what I've said, I don't know if I said it yet in this class, but go to your first sales line. You see sales revenue? I would get in the habit of drawing a horizontal line over that sales revenue right here. Horizontal line going all the way across. And the reason I do that is if you put that line there, everything below it is your income statement. Everything above it is your balance sheet. And all you have to do for the most part is copy. Just one number is going to change. And let's look at that process now. Let's look at that process. Well, like we just said, the next thing to do once we get a good trial balance is we prepare the financial statements, and they must be done in this order. You have to do the income statement first to get the income so you can put it into the stockholders' equity account so you can get the final new equity number, which you then can put into the balance sheet. We're not going to worry about cash flows yet. You have a whole chapter coming up on that. This income statement is created first by determining the revenues from and expenses. If we go back to our trial balance here, you could take a real quick look here. You could say, okay, this company has about 51,000. Let's see what they have in expenses. Let's see, 28, 29, 31, whatever, and figure out if they made some money or not, okay? The next step is to prepare the statements. Net income increases retained earnings, right? Net income is how capital grows. The net worth of the company grows by the amount of net income it earned for the period. If the company gave dividends out, that's going to reduce your equity. And these two types of activity are done through an account called retained earnings. Retained earnings is just that. Think of a company that began 60 years ago and never paid a dividend. The first day of business, there were no retained earnings. Your capital consisted only of contributed capital. A businessman or woman put $50,000 into a business account to begin. That was the net worth. And then at the end of the first month, they earned a profit of $8,500. The next month, they earned a profit of $10,000. Next month, they lost $3,000. Retained earnings is the element of capital or equity where your net income goes. So you can think of it without regard to dividends as the total gains and losses of this company from the first day it began. Okay? Retained earnings. That's where you put the earnings. That's where you retain them in equity. But if they give out dividends, you're going to learn that that's giving away part of the company, and that reduces your retained earnings, okay? Revenues minus expenses equal net income. Did you know that? I think you did, okay? Financial statement relationship, huh? Well, let's see what they have here. They're showing us stockholders' equity. Two components to it. Stockholders' equity has a normal credit balance, and so does contributed capital and retained earnings. At least we hope it's a credit balance, huh? Credit balance, normal balance. So during this period, we had net income. It's going to increase equity, but we're not going to add it to the element called contributed capital. That is never going to change unless we issue more stock to the public. So every time you have net income, stockholders goes up, but through retained earnings. Here we're looking at the balance sheet, okay? The balance sheet. Well, again, we have net income. We made money, and we just learned that net income goes to retained earnings. And now the new stockholders' equity, meaning the new retained earnings number, plus this original capital that's still sitting there, becomes the new stockholders' equity. What we've done there is we have zeroed out all of the revenues expenses in what is called the closing process. We close all what are called temporary accounts, meaning anything that appears on the income statement. They only exist for 1 month, and then they get zeroed out because we're taking them and putting them into equity. So when you look at your general ledger, the first moment of the first day of the next month, you'll have no revenues or expenses sitting there. They're gone. And now you start accumulating them again. Closing entries, huh? Even though the balance sheet accounts balances carry forward from period to period, like we just said, the income statement does not. Balance sheet represents permanent accounts. You put $100 in the bank today, at the end of the month, you had 1,000. That goes on forever. Everything on the balance sheet has an unending life, okay? It goes on for like Geico commercials. They go on forever, right? It just goes on and on. Temporary accounts are zeroed out every month. That is the balance sheet. What are we closing? We're closing the net income. So let's take a peek here. What do we close? We close revenues, expenses, gains, losses. In other words, the first 4 are anything on your income statement, and dividends declared have to be closed as well, because we're not going to show them on the financial statement, okay? So these are your temporary guys: revenues, expenses, gains, losses, dividends. This here is a very good screen to look at. Follow this step here, because this makes it a lot easier. Step 1, close the revenues. How do we do that? Revenues have a normal credit balance, right? Have a normal credit balance. So if we had a profit of, say, $1,000, how do we get rid of that income? We would get rid of it with a debit to the income statement account, the revenue account, and now it's 0, and we credit retained earnings. So we have zeroed out revenue, moved them to retained earnings. Same thing with the expenses. They have debit balances. We're going to credit every single expense, add them up, and that's going to become your debit to retained earnings. At that point, what you have is the net income. So to close the revenue, how about that? They had sales revenue, $50,000. We zero it out with a debit, and we move that revenue out of the income statement into the equity statement. So now the net worth of the company has now grown by $50,000. Sadly, though, there are expenses. So you are going to go to, I just want to see where this is taking us here. You're going to go to every single expense account and do this. Don't do them one by one. List them all down and credit each one. Skip the first line, because you know it's going to be a debit to retained earnings, then indent and put cost of goods sold, then wages expense, set whatever the expenses are. Zero them out with a credit. Add up the numbers, and that becomes the debit. So look what's happened here. We took this 50,000 in revenue here, but here's one of the expenses we're closing. Cost of goods sold. We credit it, and that goes up to retained earnings right here. So the closing entries are not too tough. There's only one other one, and that's to close the dividends, which we may or may not do in this course. But typically you close the dividends into retained earnings. Don't have to. Some companies do, some don't. And this is just a grid you might you might use if you think it's more efficient. What they're doing is here, they're giving you a T account to work with, and you close it. Here you're going to close cost of goods sold with a credit. And then you close sales with a debit. I don't particularly care for that, but you might find that easier. I think it's easier to do one journal entry, close the revenues, and then a second journal entry, close this stuff, okay? Assuming we have everything closed, if we declare dividends, we are going to close the dividends to retained earnings. So dividends, by definition, are a debit, and we're going to credit that and debit the retained earnings. So now we're done. We have now prepared the trial balance. We've talked about adjusting that trial balance. And we talked a little bit about using that trial balance to prepare the financial statements. Now, you learned to do that in chapters 3 and 4, or chapter 3, I guess we're in 4 now. So they're not showing you that process on here. And I can go over that anytime you like. Okay, so we're done. We did our adjusting entries, and we mailed out all the financial statements. For a big company, our human resources department or somebody in finance, the treasurer, made a big announcement to the world. Matrix announces record earnings. And here's the financial statements for the whole world to consider. There is one last job we need to do, one last job. After all the temporary accounts have been closed, disappeared, gone, minused out, zero, after all the temporary accounts are now zero, we prepare what's called a post-closing trial balance, which will only have assets, liabilities, and equity. In other words, for the first split second of the new month, this is your ending trial balance. Thus becomes the beginning. Notice it's just cash, assets, couple of 4 liabilities, equity. Closing entries. They remove the temporary accounts, meaning the income statement, and what's left is this. Now, the first second of the new day, you might have an order from a customer already that he's picked up. Well, of course, you record that. Now you're going to see revenue pop up. But for this 1 microsecond in time, that's your ending trial balance. Net profit margin. I'll talk about this a little bit. We don't really need it, I don't think, right now. But hey, if you take your net income and divide by sales, it'll tell you how much money you made as a percentage. Now, these are the actual numbers for Papa John's. They sold 63. They sold $1 billion worth of pizzas. It's a lot of pizza. And they got income of 63 million, 6.33%. Net income divided by sales gives you the net profit margin. This means that for every $1 of sales of pizza, they keep 6 cents, 6.33%. That, to me, sounds like a pretty good return in this era of incredibly low interest rates. Interest rates are so low now. If Papa John's instead invested $1 billion in a bank account, say just a regular savings account, they would have earned nowhere near 63 million. They would have earned maybe 1 million if they were lucky, because the interest rates are below 1%. So that's just a metric for you. And now, well, that reminds me, I gotta go wax my surfboard and hit the water, hang 10, you know what I mean? And I hope this was helpful to all of you. And it's now about 4 o'clock. So we punched in here for about an hour, hopefully got some things done. And I wish you well. And why don't you stop in and say hi, at least, for Pete's sake. I'm all by myself here at 3 o'clock. Hey, see you guys on Saturday, right? Hey, bye-bye.